Let's quickly touch on the overall market performance so far this week. Today, we've seen a bit of negativity. We've seen very light liquidity over the past week, but it's said that foreigners are starting to come back into the market, given the fact that we've got a bit more rhetoric with regards to the economic environment after the MPC announcement.
Yeah, thanks a lot. We've seen a lot of tight liquidity in the market this week. In fact, I think the interbank rate closed at around 24% this week. But if you look back during the week, I think most of the liquidity were mopped up during the, by the 4 primary auctions for the central bank this week. Mopped a huge chunk of liquidity for the market. And so, if you look at even the performance of the equities, it was a bit of stressed, there's a bit of strain. In fact, I think liquidity, week-on-week equity turnover was about down by half, from 1 billion last week to around 550 million this week. So if you extrapolate that, you actually begin to see that actually there's a huge chunk of liquidity mopped out of the market through those 4 primary auctions. So actually it's part of the primary reason why the equity has actually remained flat.
Oh, it's interesting because we've actually even heard some news out today with regards to overall East African bond investors eyeing out longer-term paper in Kenya to take hold and, of course, advantage of the yields in the country, because most are of the view that inflation has now peaked in Kenya and we could actually see an interest rate cut by the end of the year. Do you think that this is just a knee-jerk reaction, that we might just see some of the liquidity pulled back going forward?
This is a short-term offshoot from the liquidity point of view, but I think it might correct upward in the next coming few weeks. But if you look at bond yields, actually, there's a lot of trading strategies around bonds because the overall market long-term view is that the yields, bond yields, will actually gradually come down, because you've seen month-on-month inflation, year-on-year inflation, specifically January CPI numbers, very inspiring. Back from December, there's a continuation of those inspiring inflation numbers. And then off that back, we had this week MPC holding the rate. So I think the overall market view is that yields, interest rates will actually start gradually edging down. So there's a huge, very robust trading strategy around bonds for this week.
With regards to sectors that are going to benefit from a much lower interest rate environment, of course, the banks. I know you're eyeing out Equity Bank and KCB. Why are you looking at these banks specifically? Of course, earnings are anticipated as well, and they'll give a very good indication as to where we are headed from an economic perspective.
I think there's a bit of speculative strategies around full year numbers for banks, because I think from mid-February we shall start seeing full year numbers coming to the market. So there's a lot of robust speculative strategy around, and you could actually see the banking segment actually, a price-weighted index. The price-weighted index week on week was up 1% compared to last week, which was around 0.3%. So there's a bit of a stretching of betting lengths around banks, and I think it just shows you that there are a bit of optimism around full year numbers, bank full year numbers. Although the last bit of the year was not good from an interest rate point of view, but I think there's still some little glimmer, and I think we might just see the market stretching the betting lengths on banks.
So, George, you're already in Equity Bank and KCB. That is your position at this point ahead of those earnings?
Equity Bank and KCB, I think I'm still overweight on KCB. I still expect some year-on-year EPS to come above 25%. I think if you look at this bank, this is one of the biggest, it has the largest balance sheet in town. And so I expect them to substantially sweat their assets. If I take you back in 2010, they had a very kind of successful cash call, 12.5 billion Kenya shillings. And so they've been using this to recapitalize their regional businesses and also show up its mortgage business. I think we might see a very robust earnings this year. And then given the fact that they also they've had a successful transformation process. You remember the McKinsey, their engagement with McKinsey last year. So I expect substantial benefits from this,
With regards to Safaricom, it seems that there's been quite a bit of foreign participation in the stock, keeping in mind that at one point Safaricom was trading above 8 shillings, and now it seems that there's a price target on Safaricom sitting at around 4 shillings 40. A very different scenario because of the increased competitive environment, but we're seeing more interest. in this stock?
Well, actually, we might see more interest, specifically foreign interest, in the coming few weeks. Remember, this is they're actually wrapping up their financial 2011-2012 year next month. So I think what the market is trying to say that, hey, we've had a lot of, competitors substantially cutting down call rates per minute. But then if you look at the impacts on the market, actually, if you look at the elasticity limit, the elasticity of calls, it's not it's still 0.6%. Yeah. What this actually translates is that it doesn't have any meaningful impact from a caller perspective.
Yeah. Let's touch on the World Bank talking of 5% growth for 2012 and also announcing that it's investing $1.9 billion in development projects as well. This is positive news when it comes to the changes that we could see on the ground. Do you think this is going to have an impact on the equity markets going forward, given the fact that you do have the backing of the World Bank? In fact, this backing has been there for quite some time.
I think it could. Partly, but not partly, because if you look at, let me take you back. If you look at 2011, what actually drove stock prices was the fact that investors' worries boiled down to macro and financial fundamentals, and everyone was pricing in a very tepid growth rate. So if you bring that forward to 2012, I mean, Treasury just said the other day that they actually see 5% growth. It's possible. But then if you look at it on the ground, yeah. However much spending you have, the prevailing interest rate is still very high, and it's not sustainable. It's going to eat into the economy for a while, unless you check on the interest rate front.